Welcome back to the channel. Today we're going to be talking about money. Specifically, how banks create money and how that might cause inflation. So most people think that all the money in the economy, specifically the United States economy, is printed by the Treasury. That they're just printing money, printing money, and that's why we have so much money in circulation within the US economy. But really that's pretty wrong, because only 3% of the money available in the economy is actually cash, is actually physical. The real proponents of money creation are the banks, and let me explain why.
All right, so let's say that I have a bank account with a bank, right? We'll just name it Bank 1, and let's say I deposit $100, right? And let's just put this into currency real quick. So I deposit $100. Now this is how banks create money. So while my money is sitting deposited within that bank, they're gonna take my money and they're gonna lend it to other people. And just as a side note, banks can't lend 100% of the money that they have. They have to keep anywhere between 3 and 10% cash reserves at all times. And that's kind of regulated by the Fed. So in this example, let's say that our bank number 1, has to keep 10% cash reserves, all right? So what they're gonna do is with my $100, someone's gonna come to my same bank and they're gonna be looking for a loan, let's say. So this bank needs a 10% cash reserve, we'll put that there. So they're gonna take 90% of that $100, which is 90 bucks, right? And they're gonna lend that out to someone else. So right now, based off that, the total $100 that I deposited, the bank created an extra 90. So really there's $190 in circulation, but there's really only $100. So I cash deposited the 100, the bank created an extra 90, so in circulation there's $190. All right, and this effect compounds.
And before we continue, please subscribe and smash that like button. I appreciate it so much, and let's get on with the video.
So then the person that borrowed this $90 then pays a loan, say for whatever, right? Like it's a car payment or something, you can't do a lot with $90, but this is kind of in simple terms, right? So they take that $90 and they pay someone else. So now that $90 goes into someone else's bank account. And let's say that that bank also has a 10% cash reserve policy, which means that that bank is then going to lend $81 to someone else. So then the total money in circulation would be $271. So off my $100 deposit in cash to the bank has thus far created $171 more. So you can kind of see how that would compound, let's say we do bank 3. So then that $81 is deposited here, right? So then we drag these across, and then we see that we're at $344. So if we take our initial deposit and subtract it from the total money in circulation, the banks have already created $244 extra dollars. So you can kind of see that if this was in, larger terms, like $100,000 or something, then, we're creating an extra $25,000 almost off a $10,000 deposit. So you can kind of see how this could continue to compound and compound and compound and compound, and the bank is just creating more and more money based off of borrowing habits, based off of people taking out loans and borrowing money from the banks. So you see how that could go on forever? Money just keeps getting borrowed and borrowed and borrowed and borrowed through loans to create more money.
So hopefully that makes sense on how banks actually are creating money. Not physical cash, they're not printing money, but they're creating money through those loans and people borrowing money. So how does that money creation process affect the economy, specifically inflation? Let's talk about it. Now, honestly, that's a pretty complicated question, and you'd probably need to be an economist in order to fully understand that, but I'm going to try to explain it in the simplest, easiest way I know how, without adding a lot of detail or complications. That's really just going to confuse everyone, myself included. So I'll try to be brief and not super detailed and just explain it in the simplest way I know how. So there are a few different ways that inflation occurs. However, one specific way is when the money supply in the economy grows faster than the economic output. And as a side note, the Federal Reserve helps to regulate how much money those banks are creating. Without getting super detailed or complicated in how they can do that, they can indirectly affect interest rates, which is going to decrease or increase borrowing of money, right? And people go to banks to borrow money. So the more money people are borrowing, the more money is created. The less people are borrowing, the less loans people are taking out, the less money is being created. So put simply, the Federal Reserve has a few things that they can do to help regulate banks from just lending out millions and millions of dollars, just creating all of this money, right? Increasing the money supply exponentially. Because the Federal Reserve's goal is to create as little inflation or deflation as possible, right? They want to hit that equilibrium spot. If you've ever took an economics class and you know the supply and demand graph, they want to hit that middle part, right? They want to hit equilibrium. So I'm going to try to explain in the simplest way I know how, using a graph, sort of like a supply and demand graph, and I'm going to try to explain how banks creating this money could cause inflation.
All right, so I'm going to explain this using a sort of supply and demand graph, and if any economists are watching this, they're probably going to yell at me, but this will explain my point pretty well, right? So we're just going to create a graph here. This will kind of be like the price level, and this will kind of be like the quantity or the GDP or the output, right? So and then we kind of have this X, right? This graph, and here we have equilibrium. All right, so let's say we're creating this fake economy, and let's say that there is $100 in this economy. And let's say this economy lives off apples, let's say, so that we have 100 apples. All right, so you would assume that if we have 100 apples and $100 in the economy, equilibrium would be $1, right? So it'd be about $1 per apple. And then this would be supply, this would be demand, right? Supply one, demand one, right? So then let's say the Federal Reserve of this government, changes interest rates or helps regulate interest rates for banks, so people are borrowing less or more, creating more or less money. But in this case, let's say that more money is being created because interest rates are lower, so more people are going to borrow, creating more money because more loans are going out through the bank, right? To put simply. All right, so the demand is going to shift to the right, right? So we're going to have this demand curve kind of go here, so this will be demand 2. And then the new equilibrium would kind of be at this level, right? So let's say that, now there's $150 in circulation. I know that 5 kind of looks like an S. And then our new equilibrium quantity would be 150, all right? But let's say that we weren't able to produce 150 apples. Let's say instead we were only able to produce 125, right? However, we still have $150 in the economy. So instead of each apple being $1, that's going to change the price per apple to $1.25. I'll put that decimal there. All right, so this is going to be our new price. So you can kind of see how that would create inflation. It would make the apples 25 cents more when there's more supply than quantity or output, right? Economic output. Your economics professor is probably going to yell at me for trying to use this graph to explain the point, but this point nonetheless is very valid. It's just the way I presented it with this graph, they probably aren't going to like, but that explains it a little bit more from my understanding. Hopefully that helps you kind of understand that when the money supply in an economy grows faster than the economic output, that can cause inflation.
All right, so hopefully that made a little bit of sense. Please don't show your economic professor that graph, but the principle still remains the same, right? That's how banks creating money can create inflation, right? In simple terms. So the Federal Reserve tries to regulate interest rates and things like that, so people borrow more or less money to combat inflation or combat deflation. And they want to try to reach that equilibrium point. And so the Federal Reserve has a number of different things they can do to help regulate banks in lending less or more money, which is going to help create more or less money, right? Pretty simple concept. Hopefully that makes sense. Hopefully you learned something new that you didn't before. And that's all I got for you today. Hopefully you found this video informative and you learned something new. Please subscribe, smash the like button down below. I appreciate it. Thank you so much and have a great rest of your day.